Shifting focus now to the international front. Stocks and bonds were both headed for the first weekly gain in a month today as investors wagered on central banks bringing inflation to heel, through the fears of growth also dragged on commodities. Copper, a bellwether for economic output with its wide range of industrial and construction users, slid 3% in Shanghai and is down more than 7% for the week, its sharpest weekly fall since the pandemic-driven financial markets meltdown in March 2020. The price falls have also made for some relief in equities since energy and food have been the drivers of inflation. Now, after some heavy recent losses, MSCI's World Equities Index is up 2% on the week. MSCI's Products Index of Asia-Pacific shares outside Japan rose 1% today, flattered by short sellers bailing out of Alibaba, which rose 5%, amid hints that China's technology crackdown is abating. Japan's Nikkei also rose 0.8% for a 1.6% weekly gain, and the S&P 500 futures were flat after the index rose about 1% overnight. Now, the US dollar is hovering just below a two-decade high against a basket of major currencies. And still staying with the economic policy direction in the United States, the largest U.S. banks on Thursday easily cleared the Federal Reserve's annual health check in a vote of confidence for the sector amid signs the U.S. economy could tip into a recession in the months ahead. The results of the Fed's annual stress test exercise show that banks have enough capital to weather a severe economic downturn and also pave the way for them to issue share buybacks and pay dividends. The central bank said that the 34 lenders with more than $100 billion in assets that the Fed oversees would suffer a combined $612 billion loss under a hypothetical severe downturn, but that would still leave them with roughly twice the amount of capital required under its rules. As a result, banks including JP Morgan Chase, Bank of America, Wells Fargo, Citigroup, Morgan Stanley, and Goldman Sachs can use their excess capital to issue dividends and buybacks to shareholders. Those plans can be announced after the close of trading later on Monday. And going back to the energy sector now, Germany is heading for a gas shortage if Russian gas supplies remain as low as they are now, and certain industries would have to be shut down if there is not enough come winter. That's the stance of Economy Minister Robert Habeck. According to the Economy Minister, now companies would have to stop production, lay off their workers, supply chains would also collapse, and people would go into debt to pay their heating bills, and people might just even become poorer. Stated it as part of the Russian President Vladimir Putin's strategy to divide the country. Consumers could see a doubling or tripling of their energy costs, which in some cases are already between the range of about 30 and 80% higher due to the price increases from last fall, according to Klaus Mueller, the head of Germany's Bun-des-net-zagen-tur network regulator. Germany triggered the phase 2 of 3 of its emergency gas plan early on Thursday, which kicks in when the government sees a high risk of long-term supply shortages of gas. The measure is the latest escalation in a standoff between Europe and Moscow since the Russian invasion of Ukraine that has exposed the bloc's dependence on Russian gas supplies and sparked also a frantic search for alternative energy sources. Wrapping up business news now, oil prices on the international market traded sideways today after briefly rising nearly $1 per barrel as the market balanced fears of slower demand from cooling U.S. economic activities with supply uncertainty. U.S. West Texas Intermediate crude recorded a price dip of 0.59% to hit $103.70 per barrel. Brent crude now sells at about $109.20 per barrel, registering a downward price margin of 0.74%. Bun-des-net's performance is back in the green territory with a price uptick of 0.19%, selling at $115.40 per barrel. And for the OPEC basket, crude oil dealers offer $111 per barrel, recording a drop in price of 2.24%.